Let's go back to Roman's post and look at his first picture. Here's what he did wrong. Welcome to Amateur Investing. Today we are hashtag Finance Slideshow Gang. All right, so we're actually going to go over a Reddit post I found on Wall Street Bets by a guy named Roman AXT called The Big Short 2.0, Why Bears May Soon Reconsider Sucking Their Paws in Hibernation and Climb Out of Their Caves. The technical analysis thesis built on the Elliott Wave principle, market cycles, Fibonacci, and moving averages applied to SPY, which is the S&P 500. So a big part of this is going to be the Elliott Wave theory, which I'll explain in some detail, but mainly it's going to be why I think he's right and what I think he's wrong about. I really think he missed the mark in one crucial point, and I think I found the solution to the problem that he had. So he starts off with a section called the technical core, where he goes off all the different aspects he's describing. The first being market cycles. The gist of this is if you zoom out far enough, it's easy to see when you're in a bull market and a bear market. Bull, you go up, bear, you go down, and then you have consolidation periods in between. Second, you have the Elliott Wave principle. This is a way of determining different movements within a market. It has 5 waves going up and then 3 going down. The first 5 are numbered 1 through 5, and the 3 going down are A, B, C. So waves 1, 3, and 5 are impulses, waves 2 and 4 are retraces, and then A and C are impulses downward, with B being a retrace upward. And this is seen as a very common means of stocks moving within the market. Next, we have Fibonacci retracements, which are based using Fibonacci ratios against 2 extreme points in the market. These levels tend to act as points of support and resistance and are across 50%, 23.6%, 38.2%, and 61.8%. Then we have the simple moving average, or the SMA. I described this in my FinViz video, my screener video. Basically, it's the average of the past X number of candles. So the 20 SMA is the average of the past 20. In his analysis, he used the 150, and mine I used the 200. Then he lists a set of rules for Elliott Wave theory. The 3 that he highlights are that Wave 2 never retraces more than 100% of Wave 1. Wave 3 cannot be the shortest of the 3 impulse waves. And Wave 4 does not overlap with the territory of Wave 1. He follows that up with this chart that shows all major Elliott Wave characteristics. I'll leave this on the screen now for you to pause and read at your own leisure rather than having to hear me read it all off to you. And then he shows some examples. So I'm just going to put these on the screen for you to look at. The first one is DAX from 2003 to 2009. Next we have gold from 2005 to 2016. Then WTI from 2002 to 2009. Hang Seng from 2003 to 2009. Don't ask me what that is, but he posted it here. And then finally we have the S&P 500 from 1995 to 2003. But Richard, what about fundamentals? I don't give a crap about fundamentals, you nerd. But alright, if you really care, here's another picture I found from Reddit. I'll leave it on the screen for you to analyze, but it's the S&P 500 5-year cyclically adjusted earnings yield. Basically, every time that the percent was very low on earnings, guess what happened immediately after? That's right, a giant recession. So anyways, let's go back to Roman's post and look at his first picture. Here's what he did wrong. First of all, let's look at the peak. It's at 420.69 cents on the S&P 500. Ha ha ha, nice. But there's just one problem. We are well beyond 420.69. Roman, what's going on here? Another problem is he used the Fibonacci levels to line up price action, but as you can see, it doesn't really match up perfectly. Some of the spikes go past the lines, and most of them don't even reach the lines. So what did I do? I pulled up the SPY chart on the 1-month time frame on TradingView, just like Roman did. And I used what's called a market profile, or a volume profile, or a market profiler, or a volume profiler. It depends who you ask. Basically, the way it works is it shows where the highest levels of volume were at a certain trading period. And I noticed that if you take the Fibonacci lines, and instead of lining them up with price action, you line them up with volume, it matches almost perfectly. So at the bottom, I put the baseline at the very big spike of volume at the retracement. And then I dragged the 78% line up to the next spike. And then just like magic, the 0.5 and 0.382 lines match up perfectly to spikes in volume. Additionally, I pulled up the 200-day simple moving average. Now, if I use crossing the 200-day SMA as the criteria for when we're entering waves 2 and 4, then we have an almost perfect sketch of lines 1 through 5 on the Elliott Wave. Additionally, we can see that at the tops of waves 1 and 3, there's a period of 1 to 2 months of consolidation where it doesn't really hit a new peak. Assuming this pattern holds true, that means the turnaround for wave A, the first downward wave, is going to be at either 0.236 or at 0. In terms of SPY, this means the price is going to be around 471 or 554. And remember, each of these bars is 1 month, and each peak had about 2 months without a new high. So assuming this is correct, and I do believe it is correct, the right strategy is going to be to pump all your money in and ride the rest of this rally, but to really keep your eyes peeled around 471 and 554. If you see a price consolidation over a 2-month period where you are not hitting a new high, sell. If you're feeling really gutsy, buy the inverse of the S&P. Bet against it. Buy puts. I don't care what you do. I think this thing is coming down. Obviously, this is not financial advice. I'm an idiot. Don't listen to me. But I mean, look at this graph. Does this not line up perfectly? Now, I've heard of Elliott Wave. I used to think it was BS. After reading Roman's post, I was convinced. After lining it up with volume, I really think that's the right way to use this. And I'm persuaded. I don't know what else to say. This is so exact. I'm shocked. If it goes down at either of these points, I will be convinced forever that Elliott's a genius. I highly recommend you reading the Reddit post mentioned in this video. Those links will be in the description below. And if you liked the video, like it. If you hated it, dislike it. Leave a comment and subscribe. I love you. Now this is a story all about how the S&P 500 got turned upside down. So give me just a minute. Won't you sit right there and I'll tell you all about how I became a gay bear.